Our next guest believes we're going to get a Santa Claus rally and things that could last well into January. Let's bring in Nancy Prial of Essex Investment Management. She's the firm's co-CEO and the senior portfolio manager. Nancy, thanks for joining us.
Thank you.
All right, so Nancy, kind of spell it out for us. What's setting us up for the Santa Claus rally? And I have to ask, I'm going to ask this to everybody. Does the Santa Claus rally start in the build up to Christmas or the week after Christmas? And what are going to be the catalyst for it once again?
Right. So we think the Santa Claus rally does start right after Christmas, and it tends to be the most dramatic period of that will be the week right after Christmas and that first week in January, before we start to hear any news about the December quarter. And the catalyst is really the traditional end of tax loss selling, some reversion to the mean, and just the lack of news, which can drive the enthusiasm going into next year. So we think we will see, particularly in the small cap sectors, that we get that Santa Claus rally. What will continue it is the fact that we believe things are changing. We believe that the market is coming to grips with a world that is going to be very different for the next couple of years than what we've seen for the last 10 to 12 years. And what I mean by that is a world led by industrials, a world led by manufacturing, a world led by things, as opposed to a world led by the internet, by media, by technology. So it'll be a different market, but it could be a good market.
Yeah. Fun fact, if you believe the Santa Claus rally is the week before Christmas, last 2 years we've seen 5% in 2021, 3% in 2020, if you're a believer of that pre-Christmas Santa Claus rally. I also want to talk about the January effect. We're going to have people on Investopedia today, man. What do you think setting us up for that January effect? What exactly is oversold? And then what, in your mind, is going to set things up for those stocks to no longer be oversold and lead to this January effect that we're talking about?
So we've seen tremendous weakness in the smaller cap sectors of the market. And the small cap market, the small cap stocks, we believe are much more than adequately discounting the recession that we are, in fact, likely to have. Small cap stocks are not only selling at extraordinarily low absolute multiples, with a multiple on the order of 11.5 times on the Russell 2000, it's selling at a 30-year low relative to large cap stocks. We think that is way overdone, particularly in an economy, again, that will be led by the kind of factors that tend to be very favorable for small cap stocks, where the earnings growth in this sector can greatly surpass that which we will see in the larger cap sectors. Fundamentals are going to matter next year. Revenue growth is going to matter, margins are going to matter, and making money and returning that to shareholders is going to matter, and that's all good for small caps.
All right, Nancy, one last question before we let you get out of here. You're not so bullish on the S&P because of tech. You believe the valuations are still too high. A lot of people think the valuations are attractive now. There's certain parts of tech that you believe the valuations are too high because across the board, a lot of them have been basically cut in half.
Well, the valuations have certainly come down dramatically from where we were. Having said that, they are still too high. I mean, we've talked about how the multiple on the S&P is still about 18 times next year's number, which may be too high a number. We are seeing weakness broadly in tech. We've seen it in software. We're seeing it in semis. And the issue, we believe, with tech, it's 3 C's. It's capital, it's competition, and it's what I would call complacency. The sector is overcapitalized with all of the venture capital money that's gone in there. That's led to competition, which is leading to slowing sales cycles, as well as some slowing because of overspending in the pandemic. And there's been complacency in these tech companies. They've had it so good for so long. They've been able to pursue growth at any cost, meaning they could spend whatever they wanted to on sales and marketing. And that complacency is coming home to roost. They need to get their fiscal balance sheet in order. And as that happens, and then as sales start to rebound, then will be the time to look for tech.
All right, Nancy Prial, we appreciate the insight. Thanks for being here. Happy holidays.
Thank you.
All right, let's trade it. Karen, I'm going to come over to you. A lot to digest there. We talked about a lot of different things. Is there one part of what we talked about that you want to trade?
Yeah, I think the part that she talked about, complacency, is a really good one. And I think, you know, she was saying about they've been able to just grow so easily that spending was sort of an afterthought. And we're definitely seeing that change. And so I think that's going to be a catalyst for, you know, the Googles of the world. And if Meta makes a bigger shift even in cutting spending, I think that's sort of easy money for them. So I hope we do see that. We're seeing it also Microsoft slowing hiring. So I think that's going to be a potential tailwind for some of the big cap tech names that have really gotten hurt.